Hello and welcome to Money, Me and COVID-19, where we get together with leaders from the worlds of finance, business and investing to understand the impact of COVID-19 and what we should be doing to try and survive in the middle of this pandemic and then to prosper afterwards. Today I'm really pleased to welcome back one of the most popular guests from the original series of Money and Me. She's the personal finance editor of the Financial Times, so she produces the money section every weekend. She's won the coveted Financial Commentator of the Year award, and she's become a regular on TV and radio, speaking about finance and business on things like the BBC show, Right on the Money, and also on Eddie Mayer's LBC programme. She's, of course, Claer Barrett. Claer, welcome back to Money and Me.
Well, thank you for inviting me on.
Well, we've had, 8 weeks in lockdown as we record this. Have you had enough quality time with the family yet? Are you climbing the walls?
No, actually, I haven't had enough quality time because my stepchildren don't live with me. Obviously, my parents don't live with me. And obviously, we're doing a lot of Zooms, but I am missing the personal contacts. And the people who I'm missing the most of all, it has to be said, are my nephews who are nearly 5. We're doing lots of storytelling over Zoom, but you can't tell a child when it starts hitting its brother via an internet link in the same way that you can perhaps intervene in real life. So we're adjusting. I mean, obviously, I'm in a very fortunate position because I have a job and I have enough cash savings to sleep relatively soundly at night, and an awful lot of people don't.
Sure, but I guess there have been some professional implications because you're now having to produce the whole of the weekend section, I guess, remotely from home. Has that caused any new challenges for you?
Not really, because we moved to home working about 2 weeks before it was ordained that it had to be the case for everybody. So we, as an organisation, as a news organisation, we were slightly ahead of the curve. And also I work from home a lot anyway. And I think a lot of people do. A lot of people are realising now, I think, maybe managers who historically had been opposed to home working, thinking that people could skive off or that it wasn't really an ideal situation for people not to be working together in the office, are seeing that actually it works incredibly well, better than they had expected. Now, of course, we're missing contacts with our colleagues. I love getting phone calls from people who I haven't spoken to for ages, because the whole kind of like group speak can be a bit much sometimes, and it's hard not seeing contacts, hearing about news. You always kind of feeling somehow that you're what do they call it, FOMO, fear of missing out. You're all sort of insulated in your own little places and spaces, but overall the miracle of technology is keeping it all going. There was one morning a couple of weeks ago where I got up, looked at my mobile phone and saw that the Wi-Fi had gone off and thought, oh my days, and I ran downstairs and it was flashing red, and I thought, that's it. We've had it. No work, no iPlayer, no
End
music.
of the world.
Exactly, but I turned it off and on again and it was fine. So that's my advice in life: turn it off and on again.
Fantastic. Now, I would never accuse an august journal like the Financial Times of this, but I think as I look across the media generally, I think there's been a tendency to kind of over-report the health and medical aspects of this and under-report the economic aspects. We're just starting to see the first statistics now with Q1 being down back to sort of 2008 levels. Heaven knows what Q2 will look like, and big spikes in unemployment. I mean, what's your kind of overall take on the real impact of this kind of global shutdown because of COVID-19?
Well, I mean, if we start from a UK perspective, because we're in the UK and I know the most about what's happening here. So the unemployment statistics this week, just over 2 million now unemployed, and that in itself was a record jump. It's happening very quickly. What worries me more is the 7.5 million people who are currently on the job retention scheme, i.e. furloughed, with 80% of their wages being paid by the government, and how many of those 7.5 million people on the job retention scheme that's going to end up being a deferred redundancy scheme. Now, the Chancellor has extended it further into the autumn. There is talk of it kind of dwindling down in terms of the level of state support that they're willing to provide. That really is one of the key questions in terms of whether this will turn out to permanently scar the economy, as Rishi Sunak has said. The other figure to bear in mind is the 5 million people in the UK who are self-employed. So that's people in the gig economy, people who've maybe taken early retirement and set up a consultancy, or otherwise set up their own businesses, limited company directors. All kinds of people fall within that category. And of course, if they haven't got any work, many of them haven't, and if they can't get any other forms of support, many of them can't access the government help schemes for various reasons, their income stops, but that's not included in the unemployment numbers. So there's many more people than just the 2 million who sadly are without a job, who will either be fearing that they won't have one or will have experienced a really severe drop in income. And that, in the main, is going to cause problems for the economy further down the line, because of course then we're going to see the real damage being done in terms of consumer demand, spending coming back, property market, all of those things. That is really the big unknown.
Yeah, and I think you touched on consumer spending there, and it's I think I'm not sure people realise just how much of our GDP relies on people not just spending but borrowing to spend. And at the moment, if anything, of course, it's almost impossible to spend on anything other than food. So the savings rate's going up. But how do you see that translating into the economic numbers over, say, the rest of this year?
Well, I find the consumer spending argument really interesting, because obviously lots of FT readers who've still got a job, still got income, still able to work, professional jobs, most of them can work from home. They're having a very, very different lockdown experience to people who are in more manual employment, who can't work from home, who don't have a contract, are self-employed, feeling much more insecure. So somebody like me, for example, my income is still coming in, thank you very much. And as you say, the amount of things that I can spend that income on is going down. I mean, I am buying quite a lot of wine online. I have to say, I'm buying lots of books online, and I'm finding that I can spend my money in some ways, but of course I'm not having to spend on transport. For most people, after their mortgage, the single biggest expense is going to be their season ticket. Good luck if you're trying to get a refund on those, because they're taking a while to come through. But then, people call it the Pret tax, the amount of money that you would spend on coffees and lunches because you're in a rush and you don't have time to prepare, the amount of money that you would spend in the kind of hustle and bustle of daily life, cafes, restaurants, meals out, etc., all of that is gone. Now, as the lockdown eases, there are a lot of these hospitality businesses who are trying to reopen in some way, shape or form. I was on my local high street this morning, because I go out very, very early and have a run around the park, and I noticed that the cafe has opened to do takeaway coffee only. It wasn't very busy. And it's kind of like, well, if you don't have a reason to go out and walk past the cafe, then you're not going to go in there and spend £3.50 or whatever on a cappuccino, even if it is very nice. And a lot of people are either thinking, I haven't got the money to spend on a cappuccino anymore, or they might be looking at their bank balance and thinking, why have I spent all of this money in the past on things that I don't really need? Because it's really quite astonishing, if you're not spending at your usual rate, how quickly that extra money can add up. Now, one of the most popular questions that I'm being asked by FT Money readers, particularly the kind of ones who are around my age, maybe a bit younger, is, what do I do with this extra money? I'm in a lucky position here, but obviously interest rates, inflation, best you can get on a UK savings account at the moment is about 1.1%. And people are thinking, well, maybe now's the time I can start getting invested in the stock market, because they've been put off for years thinking the stock market is overvalued, it's been going up and up. And that is amazingly already being reflected in the number of new account openings at the big brokerage platforms, lots of them by people who are in their 20s, 30s and 40s, plenty of women as well, first-time investors who've never invested before and then are thinking now, this is a potential bargain buy, and maybe if they did that in March, certainly markets have gone up again since, you know, the really dark days. Bigger question, of course, looking forward, is that going to continue?
Well, yes. I mean, I think we're seeing one of the biggest disconnects I can ever remember. I know they're never perfectly in balance, but when we have this massive economic catastrophe going on and markets going back up again another 20%, it does seem somewhat unreal. But do you think this is what they call a sucker's rally, and we're going to head to see some further falls as the full impact becomes apparent?
I think that stock markets are going to be impossible to predict and extremely volatile for a long time. And the problem for any investor who would read FT Money is that they would be a long-term investor, because that's absolutely what we preach. You know, I'm not the kind of person who'd have short-term trading. I'm not the sort of person who would advocate trying to buy the dip in order to make a quick buck. If you want to do that, you know, that's fine for you. But most of our readers are looking for the long-term investment return. They're saving for retirement. They've got a horizon of, you know, 20, 30, 40, maybe even 50 years. But the problem for us is that these long-held assumptions about investment itself are being questioned. And you see that particularly with our older readers who have either already retired or are approaching retirement. And I think that, yes, you could say, well, you know, they're hardly a group of people to feel sorry for, because they've built up a lot of wealth over the past few decades. They've certainly, you know, probably got an outright property ownership or two to be thinking of. So they're certainly not lacking in assets, but they have seen this huge calamitous turnaround in fortunes just at the point when they were hoping to start their retirement. And of course, for one of the, you know, 500,000 people or so who've gone into a drawdown pension arrangement since pension freedoms, then you're relying on generating an income from your pension fund. Now, that's something that I'll have to do in the future, because I don't have a final salary pension scheme to look forward to, unfortunately. And all of the assumptions about being able to generate income at the moment have already been snuffed out. We've seen huge dividend cuts, not just in the FTSE, but all around the world. In Europe, in America, companies are conserving cash, they're stopping share buybacks. And this means that if you're the kind of investor who relies on taking the natural yield, as they call it, from their portfolio, you've had a very thin year. Now, if you're the sort of person who has got a couple of years worth in the tank in cash to sort of ride out the bumps of the stock market, because nobody expects it to go up in a long line forever, then that will, of course, give you some respite from what's happening now. But the question is, you know, how long will it go on for? Will this reset the level of dividend payments going forwards? I think it will. Plenty of other investors do too. And then the assumptions that we're all making in our long-term financial plans, for example, how much will I have to save into my pension now in order to be able to buy a particular standard of living at a certain age when I retire, is all in flux. So the thought I'm left with is, it's a good thing that I enjoy journalism, because I may have to do it for quite a while longer before I can hang up my pen.
Absolutely. But of course, you mentioned obviously stock market and dividends, which is one area of investing. But if there was one single kind of default investment for Brits over the last decades, it's been property, especially buy-to-let property. Now, you know, buy-to-let landlords have already been through an awful lot of changes in the last 5 years, which have weakened their position with tax and so on. And now they're even worried about their rent and what's going to happen to the property market post COVID-19. So you know, what's your kind of take on the whole property implications of COVID-19?
Well, I have lots of thoughts on this, partly because I used to be a property journalist for 10 years. That's how I started off. And I've got lots of friends and contacts who are landlords. And at the moment, they are all being deluged with calls from tenants, particularly in London and the southeast, saying either we can't pay the rent, can we have a rental discount? What will happen if I lose my job? Lots of kind of reassurances being given on either side. Buy-to-let landlords technically can go and claim the government's 3-month mortgage payment holiday if they want to, but I have yet to meet a landlord who's done that, because they all fear it could count against them further down the line if they want to refinance, which buy-to-let landlords obviously need to do periodically, or if they want to borrow more to buy more properties if we do see a crash. Because the really serious landlords who are not highly leveraged now are thinking, could an opportunity be coming around the corner? Now, to caveat that, we're going to see obviously pain in terms of rental voids, in terms of lower rental income, and expectations of rental yields certainly are going to come down. But then there are also reasons to believe that the rental market could start to come back, because there are an awful lot of people, particularly first-time buyers, who now may not buy and may be renting for longer. So people talk about the online trends accelerating under lockdown, for example, online banking. You know, are we going to see more and more bank branches closed because more people are being forced to bank online and finding out it's actually quite good? Well, one bank branch that I predict will be the first to shut in this crisis is the bank of mum and dad, because if you're thinking, I will give my son or daughter 50, 60, 70,000 pounds, maybe more than that, as a property deposit, why would you do it now? Because if the prices are going to fall, then they could get more for their money in a few years' time. But more likely, even people who are quite wealthy, that's a really large capital sum. So to give it away when you don't really know the implications for your pension, how your retirement might pan out, what your own property price might be worth, there's suddenly quite a lot of uncertainty that's come back. So I think it is possible that the rental market will not be on a one-way ticket to doom. Certainly the landlords are really, really worried about the potential redundancy problem. I do think that any landlords watching this, the ones I'm talking to, are all sort of looking through their paperwork and saying, what is it that my tenant in this property actually does? Because if they're a doctor, a nurse, they're going to be fine. If there's somebody who works in the travel industry, or maybe in physical retail or in the restaurant trade, then obviously there are going to be different sectors that are going to be more suddenly affected by all of this. So it really is a mixed bag. But then property prices, how long have you got for this programme? Because my goodness, that is the topic du jour at the moment. Now that the property market has opened up again, we've had just over a week now where physical valuations and viewings have been allowed, and definitely there is a huge surge in demand and enthusiasm from estate agents to get deals done that were kind of put on hold in the lockdown, because obviously they're desperate for fees. One of them said to me on the phone this morning, I haven't eaten for 6 weeks, meaning I haven't had a fee come in. So there is real desire to get transactions to close, but at the same time there's huge paranoia on the part of the buyer, thinking, well, how much of a discount can I get? If they're a first-time buyer, that's obviously a very different prospect to if they're in the middle of a chain and trying to move. And we're seeing a lot of chains at the moment breaking down because of these kind of negotiations going wrong. And my only advice to anybody who's in the process of buying a property at the moment is, is it really the property you want to buy? Is getting £10,000 or £20,000 off the price really going to affect your enjoyment of that home for the next 20 years if it's somewhere that you're looking to spend a long period of time in? Because there are a lot of deals at the moment that are going to fall through because the buyers can't agree on price, and it's going to take a long time with transactions at the low levels that they are for serious kind of evidence about any pricing erosion to emerge.
So what would be your best guess at the moment? Would you expect to see some kind of reduction in prices as people seek discounts, but there'll be a standoff while the buyers won't accept those prices? But do you see a generally deflationary trend in house prices for the near future?
I think it's hard to see house prices going up, but if we remember the last crisis, the financial crisis, and I was a property owner before that happened, I was able to get a mortgage to buy this flat, the one that I still own and live in now, really easily in way back when was it, 2004, 2005. This was the days of the self-certification mortgage and free and easy lending. It wasn't quite so free and easy for me, but certainly I was able to borrow and buy. And all of a sudden, when the credit crunch hit, if I hadn't have bought, friends who hadn't been as savvy as me, if you like, as directed by my parents saying you really should buy a property and stop spending all your money down the pub, they weren't able to get on the property ladder after that happened, even though we earned the same amount of money, just because the banks weren't willing to borrow. The banks weren't willing to lend to them. So that's really the big unknown here. Clearly, about 1.5 million people have asked for a payment holiday on their mortgage already. They're the ones that we know about, and that is before the effect of unfortunate redundancies and other bad news that's to come has kind of washed through the system. So the mortgage lenders are going to be very conscious of risk in people who they're lending to. There has been a lot of products that have taken off the market. We're starting to see a few more of those higher loan to value products coming back on, but I think that I would not be prepared to say that property prices are going to survive unscathed. Put it that way.
Okay, most of the people watching us will probably fall into the sort of higher income, higher net worth bracket, and at the moment they're seeing themselves as kind of, target number one for Rishi Sunak in his next budget. What are the sorts of things you think they should be afraid of and that might be coming down the track?
Okay, so we have a Conservative government. Conservative governments have traditionally been very wary of raising taxes, but I do think that we are going to get some tax rises, maybe announced before the next budget, which will be a big blockbuster in the autumn. We've already seen, thanks to some leaked Treasury documents, that the government is looking at how it could raise some taxes to pay for the ballooning budget deficit. Now, it doesn't really need to raise any taxes if it doesn't want to. It could borrow most of that money to smooth over the gap. Certainly borrowing money at the moment is very cheap. As anyone who's able and has a good credit record, you can still borrow, will tell you. But the problem is how credible it looks if we just borrow our way out of trouble. And there seems to be considerable public support for limited tax rises. People want to help the NHS, for example. They want to pay back public services. A lot of people would like to see nurses get a pay rise. And I say that, disclaimer, my stepson is a nurse and he has never had to work so hard. And, we have never been so worried about him. So do they deserve a pay rise? Absolutely they do. But that money has got to come from somewhere. So in terms of how the wealthiest could be taxed, there's definitely fear of a one-off tax of assets, a wealth tax coming in, if you like, which may sound more like the policy of the Labour Party than the Conservative Party, but certainly people are fearful of it. There's been no suggestion from the government that that could happen. What's more likely is the period of time, if you like, for sorting out some knotty problems within the British tax system that have existed for an awfully long time, that have eluded previous chancellors. So, for example, let's look at the taxation of the self-employed and national insurance. He already warned when he gave the self-employed access to the government grant scheme that he wanted to level up the way that they were taxed. Now, at the moment, they pay slightly less national insurance than people in employment, but then there's also the impact of them not getting the employer's national insurance contribution. So that has rattled a lot of self-employed people who, let's face it, are really suffering at the moment anyway. As somebody who saves into a pension, the one that I am worried about is higher rate pensions tax relief. So for years I've benefited from this and I've made good use of it, because every single budget you think is either going to be cut or gotten rid of completely. So I'm still paying the full whack into my pension to benefit from that 40% advantage, because I fear it may not be too long for this world. Now, they wanted to get rid of this. There was some discussion of it before the last budget, and then it was actually the NHS and the taper tax problem that took that off the table. But now, will they go back to it and have a look again? They'd have to work out how to do it in a way where they wouldn't be seen to punish people who are working in the NHS. But I think that is something that could be on the cards. I also think that they could raise the rate of national insurance for higher rate taxpayers as well. Currently over £50,000, you're paying 2% national insurance, but below that you're paying 12%. They could raise it to 12%. it's not technically an income tax rise because it's national insurance, so it's a bit harder for people to understand. It's still breaking a manifesto pledge if they did that, because they obviously said they weren't going to raise income tax, NI or VAT. But if it's something that's seen to kind of hit higher earners rather than lower earners, then I think the political will in the country is there. People are prepared to sort of put their hands in the pocket. If it's for a limited time, I think people would be very understanding, because the strength of the government response to the crisis has been great.
Okay. Now, one of the, I suppose, about the only benefit we could argue for COVID-19 is that it's actually taken Brexit off the agenda. But I think to me, some of the decisions that Rishi Sunak makes this year have really also got to set the stage for a post-Europe Britain. So, for example, I've heard debates about whether corporation tax should be raised or lowered. And if you're thinking Britain should be, the Singapore of Europe or whatever, you want to see lower corporation taxes. What do you think should be done in the context of both enabling the post-COVID recovery, but also laying some foundations for Brexit Britain?
Well, I think that one of the reasons that the focus has been about what could happen to personal taxes has been because we think that, sorry, let me start that response again. I think one of the reasons that people are focusing the tax rise fears so much on personal taxes is because if you raise tax on businesses, that is going to absolutely derail any hopes of economic recovery. We need to keep the tax burden on businesses as light as possible. We need businesses to keep as many people in jobs as possible, and certainly all of the pumped into the furlough schemes to keep people in jobs at the moment, they would hope has sort of deferred and hopefully alleviated some of the economic damage that could otherwise have resulted. So there's a huge amount of pressure on the Chancellor to be kind to businesses. Now, for investors, there are also implications to this, because we're already seeing that companies who are taking government loans, for example, big bailouts, they've increased the amount of money that they're prepared to lend in the government-backed loan scheme to the largest firms. And I think there's going to be a lot more take-up of that over the next few days. It was only announced yesterday. But the quid pro quo is that they can't make dividend payments or pay cash bonuses to directors. So, there are conditions, if you like, for the government coming in, because they don't want that money just washing out of the company into the pockets of investors straight away. So that, again, is going to weigh on the investment side of the equation, even if business performance and economic performance well. So going back to what we were talking about at the beginning of our conversation about looking at the long-term picture as an investor, you've got to think that in terms of the average percentage growth that you would hope that your portfolio would manage over the next 5, 10, 20 years. I've certainly reduced my own estimations down by a couple of percent, and that may turn out to be, completely incorrect. And it might even be a few percent lower than that. It really is impossible to tell at the moment. People say it's going to be I think we're through the V. Nobody thinks it's going to be a V shape anymore. Could it be a W, or could it be an L? Could it be something that just takes us 10 or 20 years to pull back from? It's quite a depressing. Easy answers.
Indeed, and I think one of the core kind of factors that would weigh into somebody's investment decisions and their asset allocations, whether they think we're going to be living in a deflationary or an inflationary environment for the rest of this decade. And to be honest, I get different answers from everyone I speak to, because we've got these conflicting forces of, locking down the economy, obviously being deflationary, but pumping loads of money into it being inflationary. So what do you think the net of all that's going to look like on that deflation to inflation spectrum?
Well, so the deflation that we're seeing occur at the moment is quite staggering, and a lot of that is down to to petrol prices, to energy prices, which has kind of been a bit forgotten in the pandemic crisis. That what's been happening with the oil wars, and that in itself is a fascinating story, but how much demand is going to be taken out of the economy? Like we were talking about coffee shops earlier, do I really need to buy that cup of coffee? I mean, I think a lot of consumer spending, for one reason or another, is going to vanish. Some economists call it the paradox of thrift. As an individual, I've always been very thrifty, but if everybody did it, then economic demand would collapse, and this is the effect of the lockdown. Everyone is doing it. Now, on the subject of inflation versus deflation, certainly as somebody who does have quite a bit in cash savings, deliberately so, because I've been worried for a while that the stock market was overheating. I have money in cash. I haven't rushed back in and bought the dip, as some are doing, and you see that reflected across investment platforms. People in general over the last 2 or 3 years have been holding higher levels of cash, because cash is the ultimate decision deferring device. Now, I have got in the back of my head, if we do see inflation really ramping up again, I don't think it will happen immediately, but if you look back to 1970s, I wasn't alive until the last 3 years of that decade, but when that hyperinflation happened, it happened very, very fast. You don't get much warning of massive rises in inflation. So I think as investors, you've got to be aware of the bigger picture, and you've got to think about balancing, your needs for kind of comfort and security and holding cash, and the long-term nature of the investment choices that you're making. One big thing that I do think will, it was already trending before this crisis hit, and I think it can only get more popular now, is ESG, environmental sustainable governance, green investing, if you call it. The ESG funds have actually performed not badly in all of this, because they didn't have exposure to the airlines, and they didn't have exposure to the big oil companies. So they've had a good start. I think a lot of people have got more interested in ESG as a result of that. And it's certainly an area that personally I am interested in, and thinking about the kind of investor I want to be for the next 10, 20 years. Certainly ESG would be a part of my portfolio.
Okay, and as we come to the end of our time together, Claire, I just want to raise a topic which has, I think, been gathering some momentum recently, and that is really the not so much the economic discussion, but the impact on our personal freedom and liberty of the lockdown phenomenon. We saw back in 2008 the kind of QE money printing genie was let out the bottle, and it's certainly never gone back in. It's used more than ever. I think there's a risk, or some of us feel there's a risk, that now that the lockdown genie is out the bottle, it can become another tool of government. And I recently interviewed an entrepreneur called Simon Dolan, who's actually mounted a legal challenge to lockdown. What's your take on this sort of liberty versus safety spectrum, and whether there are countries that have succeeded in having a better COVID-19 outcome than us without a lockdown? Do you necessarily think it's been the right approach, or are you firmly in the camp that this was kind of the only choice the government had?
Well, I mean, personally, I haven't minded the lockdown. I'm very lucky. I can work from home. I can still earn money. I've still got a job. I've got lots of books to read, as I see you have too. And I'm able to live with that, because I don't want my health to suffer by getting the virus or by passing it on to other people. But at the same time, I realise that there are many other people, millions of people, who don't have those things, and there is an imperative that we do get the economy again to avoid the scarring that the Chancellor speaks of, the loss of jobs and the loss of economic demand. But these are very, very difficult decisions to make. If we make the wrong decision, we get another big spike in cases, and obviously that's going to cause more economic damage, because the lockdown will have to be tightened again. So I'm happy with the decision to proceed cautiously, and I just feel that it's a period of time that hopefully back on in years to come and talk about how we survive the great lockdown of 2020, hopefully with Wi-Fi that works, because that's the big swing factor. If you ask me again next week and my Wi-Fi has gone off again, then you may get a very different response.
Okay, brilliant. Well, that's sadly all we've got time for, but great to catch up with you. Thanks a lot for joining us, Claer Barrett.